Starbucks is down 15% in the past week after they reported earnings, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Google Sheet to calculate the intrinsic value of the company. Starting with the financials, this company has consistently grown revenues around 10% over the past 10 years, with the exception of COVID years, going from $15 billion to 36 currently, and analysts are also expecting 10% growth over the next 5 years, reaching $59 billion. Regarding profit, it has doubled over the past decade, net income and free cash flow going from $2 billion in 2014 to $4 billion currently. In this regard, analysts are expecting them to reach $8.04 per share in 2028. If you assign a 20p to the company then, it would make it a $160 stock, meaning 112% upside. Their earnings were very bad as they missed on EPS by 15% and revenue by 6%, and their outlook for the rest of 2024 has been slashed. Revenue is now expected to be low single digits compared to the previous forecast of 7 to 10%, and earnings are expected to be flat, down from the previous forecast of 15 to 20%. Then, in order to calculate the intrinsic value of the company, I used my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. I went with 12% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $75 per share. Therefore, if the low assumptions occur, you're going to make around a 6% annual return on your money, middle 15.5%, and high 24.5%. For my revenue assumptions, I did 7% annual for my low, 10% on the middle, and 13% on the high. I assumed a profit margin and free cash flow margin of 9% on the low, 12% on the middle, which is around what they have done over the past, and 15% on the high, because their gross margin is around 68%. Therefore, I believe they have a lot of room for improvement. I assigned a P and price to free cash flow of 17, 19, and 21, and left the share outstanding change at 0%. However, the number of shares outstanding is considerably lower than it was 10 years ago. And if we assume that they buy back 2% of their shares annually for the next 7 years, the valuation becomes even more attractive. These returns include the dividend, which has a 3% yield at the moment. The payout ratio is 62%, and therefore it appears to be a safe yield as they can afford to pay it. However, they may have to cut it if times are tough. The Excel spreadsheet does not take into account the balance sheet, and Starbucks has a very good balance sheet as they have $3 billion in cash and $24 in debt, which is not a lot for a company that has a market cap of $84 billion, and considering the majority of that debt are leases. A very important metric regarding this company is ROIC, or return on invested capital. This company has a 25% ROIC, while the market average is around 10%. This means they are very effective at investing its capital in order to increase profits, meaning they can go at a very fast pace. In conclusion, I believe Starbucks is a great company with still a lot of growth potential that is going through short-term problems and that is trading cheap at $75 per share. I hope you found the analysis valuable. Let me know in the comments whether you think Starbucks is a buy or not, and I'll see you in the next one.